Good evening, everyone. Welcome once again. This is day 3 for the Investor Education Week, and I hope the last 2 days have been well. I still see same people, and I see more people who have joined today. So I see many names which are familiar, which I have been seeing from last 2 days, and I see a few more names which are newly added. And not surprised, there are a lot of registrations for today's session for the fundamental analysis. That being said, please just 1 second. I will switch on to the platform. So we have been able to successfully upload the last 2 days on YouTube. So whatever was discussed in last two sessions is already on YouTube. You can subscribe to the channel Century Financial, and you will get to see the videos which are uploaded. So that is something which you can do, and keep subscribing us. Keep looking at a few more videos we do. There are a lot of market videos we are doing, platform tutorials, and a lot of stuff. Right. Before I start, uh, would just like to thank everyone for continuing with this session. It's not easy to come almost every day, give your 1.5, 2 hours and listen to me. And you all have been doing that very nicely. You have been asking questions. I have been trying to give you a lot of answers. At the end of the day, if there is any kind of a problem, or if you're not able to hear it, or if there are any doubts and which I'm not able to clear, please reach me out for one-on-one sessions. I'll be available to conduct personal training sessions as well. And that is something which we are doing over this month, and we'll continue to do it. I hope by now you must have spoken to your relationship managers. They must have given you demo accounts and newsletters, because we will discuss the newsletter also today, because that's all fundamental news is all about, fundamental analysis is all about. News information, we'll discuss about some ratios. So what we have done in last 2 days, let's try to just preview it. We started with the understanding of the product library. We understood how many kind of products we have: commodities, currencies, cryptos, indices, forex indices. Then we talked about share baskets. We talked about exchange traded funds, shares, and then the very next session we tried to understand that what CFDs are, how margins are being used, what is short selling, what is leverage, how to put a stop loss, how to do a proper risk management, how to diversify. Not only we did that, we took some trades after the US opened, and we saw the impact of diversification on the portfolio. And we also understood what happens when you leverage too much, what happens to your risk. So we agreed on the point that we should not be very aggressive. We should be in complete control. We should try to control our emotions when it comes to trading. Now, today's session will be a next step to what you have understood. So far, you understood how to execute a trade, and you understood what the product is. Now, the most important thing will start, uh, the fundamental analysis. When you take a trade, on what basis you go for a buy or sell? This is a field which is really vast. At the end of the day, nobody can say 110% that, okay, this decision is right and I'm going to go with it. But there are always indicators, there are analysis, there are tools which help us to derive to a specific conclusion, right? We have to hang on to something. Like, for example, if I tell you 2 plus 2 is equal to 4, and if you ask me, okay, prove it, there's no proof. I can count 2 plus 2 is equal to 4. Why? Because we are hanging on to a basic principle of math, what we see, on the basic principle of numbers. So today, if I tell you about ratios, I tell you about the tools which are used in fundamental analysis, you have the complete right and authority to ask the question back that, okay, what is the authenticity of all this? What if it doesn't work? The answer to that question is there's a very well chance that it may not work in certain circumstances. So that's where your diversification and your stop losses and your risk management comes in, because analysis is done on the basis of events. When we are talking about fundamentals, it is done on the basis of events, and those events can have a meaningful impact, cannot have a meaningful impact. It depends on the market sentiment, the investor sentiment, how the investor is feeling. So normally in India, they have this thing, how's the Josh, right? So we have this thing in our markets. How's the sentiment? So we work on the sentiment, right? Okay, let me just check if the platform is all set. We will, we won't look much at the platform today, but definitely when the US opens, we will have a look of how the markets are performing. If you have seen yesterday, we were looking at a lot of trades. Uh, I'm ready to take a couple of reviews if you want. Anyone who tried a demo account, any feedback, good, bad. I told you to do a couple of trades and write a rationale behind it why you have done it. Anyone who has done this? Anyone can just send me a quick chat. Anyone who did the assignment which I gave. I know it was on a very short notice, and a lot of people, you guys are juggling around with many things. So I really appreciate you taking out time. And anyone who has done the assignment, okay, never mind. Just send your relationship managers that email which I told you to, with the traits which you have taken and the rationale behind why you have taken it. See, guys, if you have not done this, please understand there is no point of having the demo account and not using it. So please try to do this. Try to also, okay, I just got a question to explain stop loss. I will explain the stop loss. Once I finish this presentation and we try to work on the platform, we will again just go through a very basic trading and how to put the stop loss. Okay, still not clear how to do with intraday swing and long investment. So, okay, but for now, I believe the execution of the trade should be clear, how to do a buy, sell, and put a stop loss, because that's the first thing. And obviously, we'll proceed further. So today I'm going to tell you about fundamental analysis. And before we start the session, once again, on behalf of Century Financial, my team, and myself, from everybody, thank you so much to anyone and everyone who's in the medical industry or a part of healthcare sector, to all the first responders, doctors, nurses, and midwives. Thank you so much for risking out your life. And I wish you a healthy time and a healthy life once this is over. I hope that this time gets over and everybody gets back to the things the way they were. Now, starting with the fundamental analysis, there are two kinds of analysis. One is fundamental and another is technical. Okay, there are more attendees today, so the people who have joined today, the drill is, I explain you things. If there is any problem, or if you're not able to understand anything, just write it over a chat and I will receive a question here and I will be able to answer your questions. If I'm not able to answer your questions right now, definitely one of your RN relationship managers will reach you out and we can connect and we can have a one-on-one session as well. Now, there are two kinds of analysis. One is fundamental, one is technical. Technical, as I say, is all about charts. It's all about fundamentals. And sorry, it's all about charts and it's all about historical prices. Okay, so those who are right now sending me, okay, the execution of the trade is clear. Would like to know more about future forecasting and technicals. Also, where do we figure out resistance support? So those who are interested in charts, resistance supports, just wait for one more day. Today is fundamental, tomorrow is technical, step by step. So we'll understand the fundamentals first, and then we'll move on to the technicals. And those who cannot log into the demo account, please uh, call your relationship managers. They will assist you. Now, again, going further, so there are two kinds of analysis. One is fundamental, another is technical. Technical is all about charts, historical numbers, data. Fundamentals is much more about sentiment and market information, right? So when we talk about fundamental analysis, we have to understand we're talking about uh, different kinds of methods. So what is Warren Buffett's mantra? Warren Buffett's mantra is to find out the companies which are undervalued and buy and keep it for a long period of time. That is what Warren Buffett says. right? His idea is very simple, that if it's a stock, say Coca-Cola, you have to find out the real value, or what he calls the intrinsic value of Coca-Cola. And what is the intrinsic value and what is the real value of Coca-Cola? That is the value at which you should be buying the stock. Now, how to find that intrinsic value? How to find that lowest value? You can also call intrinsic value as a value below which it is not expected for the stock to come down. So today, if I say that the intrinsic value of gold as a commodity is $800, so that $800 could be its mining cost, could be a cost below which gold prices cannot fall, or it is, at least it is expected that it cannot fall. That value will be called its intrinsic value, right? Similarly, in case of stocks also, there is something in the, when we talk about fundamental analysis, the idea of fundamental analysis is to find out the real value or the intrinsic value, normally, where through below which that particular asset class will not fall. So if I'm looking at Apple stock and if I say Apple value, intrinsic value is 85, now that means that below 85 Apple stock should not fall. So I would wait for Apple to come to 85 to start buying and keeping it, because 85 is the intrinsic value. How do you calculate the intrinsic value? There are a lot of tools, there are a lot of ways, and obviously it's not necessary that every time you will calculate and there it is the intrinsic value and you buy and it will not fall. Okay, there are a lot of ways. You always try to find the best of the value. This is an attempt to find the real value of the investment, right, or of the asset class. Now also, what we will discover today is the fundamental analysis, how it works, and we will also try to use it in practice. We'll cover asset class like stocks, commodities. We'll cover asset classes like Forex also, and try to understand what are their fundamentals, right? Now, fundamental analysis basically it uses a lot of resources. Like if I'm talking about a company, I'm talking about the financial statements of a company, the trend of the industry, the market releases. So to be very layman and to be very sounding it very easy, right now we all are doing this kind of communication on Zoom or WebEx. This is the trend right now, and you see the Zoom communication stock going up. What is that? That is the fundamental analysis. Okay, just a part of fundamental analysis. So industry trend is one of the most important factors of the fundamental analysis. So this is what we normally hear. We look at the market news, we see the overall market news, and we decide that okay, this is the trend of the industry, this is the stock which is performing, and we should enter into this sector. But there is a lot more than this. Now, fundamental analysis, it will aim to determine that if you should buy any asset, like at the data which you see, or you should wait for the intrinsic value. You should analyze all other market factors. And depending on which asset class you're analyzing, say if it is Forex, then it's a bit different. If it is stocks, then it is different. So that's why what we have done is we have divided the fundamental analysis into two kinds, right? We are looking at, just a second. We are looking at two different kinds of analysis here in within fundamental. One is quantitative fundamentals and another is qualitative fundamentals. By the name itself, it would be slightly clear to you. When we are talking about quantitative, we are talking about like any kind of numbers. Quantity means quant means numbers. So this particular kind of fundamentals will be helpful. It will be useful if you want to compare, let's say, instruments into the same industry. Okay, so for example, there is tech industry, there is Amazon, and there is Alibaba. So if you want to compare which is a better stock, Amazon or Alibaba, you will look at their revenue, you will look at their liabilities, you will look at their ratios. So all these kind of quantitative values, where you will find these values in the balance sheets, in the financial statements. You will notice that the financial statements of all the companies which are listed in stock exchange, they are publicly available. They are publicly available. You want to see their numbers, you want to see their quarterly revenues every quarter. Now, this is a very important thing. Please remember this. A company which has taken money from people and issued shares, it is called going public. So when you hear about IPO, that is called initial public offering. Initial public offering means that this is the start where the company is borrowing money from people, or not borrowing, inviting people to invest into the business, right? That is why it is called public offering. They are offering shares to the people so that they can come and invest. That's why it is called initial public offering. Any company which is listed in a stock exchange, it is liable for them to come up with their quarterly reports and earnings, because as investors in the company, if I invest into a company, I would like to know how they have performed. And it's just like a report card, except it's not yearly. Every quarter a company has to come up with their quarterly report card, and that's why every quarter comes earnings season. Okay, earning season is kind of a big thing in stocks. There's a lot of movement in during earning season, and every quarter, lot of shares come up with how much revenue they have made, how much earning per share they have generated, what is the expectation for the next quarter, what did they do differently, what was the upside or the downside, everything, right? So earning season turns out to be one of the most interesting times during the stocks. So if there's 1 year, the earnings will come out in January, April, July, October, 4 times, right? So over a period of year, you will see 4 times the earnings coming out. This is every quarter, and every each one of that quarter will have a lot of volatility and fluctuations in shares. So studying that earnings is also part of fundamental analysis, because you take decisions on good earnings or bad earnings, and that it comes into fundamental analysis. So quantitative, when I tell you quantitative is about numbers, but it is not about historic prices. Numbers doesn't mean historic prices. Numbers mean that if I have to compare in the same industry, let's say in beverage industry, if I have to compare Pepsi and Coca-Cola, so I will see which of these companies have higher liabilities, right? Lower dividends, or higher debt or low debt, or PE ratios, or higher earnings, lower revenues, like this. So we have to understand numbers in terms of quants, and quants are present into balance sheet, right? And then comes your qualitative fundamentals. When we talk about quality fundamentals, we are talking about, now, quantity can be measured in numbers, quality cannot be measured in numbers. So let's say we look at the board of directors, right? I'll give you a very good example of a qualitative factor. Few years ago, I'm not sure how many of you have heard about it. Few years ago, Volkswagen automobile company created a car which they marketed to the people in Europe and other parts of the world, that it cuts out emissions, carbon emissions by 50%. Now, people take environment very seriously. No matter what Donald Trump says, environment still a very big factor for some of the people. And when a renowned company comes up with a car which says that it is going to reduce the carbon emissions in the environment by 50%, people would switch to it, and that happened. A lot of people bought that car, and that happened. I think, yes, in US or in Europe, uh, around the world there were many people who bought Volkswagen cars because of the same reason. And it was seen afterwards when there was a proper testing of the emission uh, devices, and when the car was put to a test, even before it was being launched, they could not find out any factor that what they are marketing is a lie. They could not find any such factors, so everybody believed that what Volkswagen told the consumers was right. But later on, a proper investigation happened, and it was found that the Volkswagen cars were fitted with a de facto device, which, when being tested by the authorities, will always show reduced emissions. That means the device was being tampered with, and it was something which Volkswagen senior management board of directors, they knew about it, and then that happened. It was obviously considered as a cheating, right? Volkswagen was fined billions of dollars, a lot of vehicles were reclaimed. Stock came down, right? But the stock came down before there was any reclaim or any fine or any kind of, only the news came into the picture that this is what being investigated, and the stock started coming down. So this is something which is qualitative fundamental. You cannot just, so what if anybody has bought a car thinking that this is going to reduce the carbon emission, I'm contributing it to the environment, he feels cheated. That's a qualitative fundamental for which the company has to pay. You cannot measure the disappointment of someone in numbers. So qualitative fundamentals is all about understanding the broader picture, a different perspective. These kind of factors are normally driven by opinion, and it's really hard to compare when it comes to qualitative. See, if you have to compare numbers, you can always compare numbers, but when it comes to qualitative fundamentals, you cannot. So that's why it's really a tricky part when we talk about fundamentals, because fundamentals, one part is quantity, another part is quality. Now, once we have understood quantitative and qualitative, let's proceed further. How to understand about different asset classes. For stocks, most of the time, fundamental analysis is used for stocks. Okay, but then when it comes to commodities, currencies, there are some of the other fundamentals which are affecting them also. So what we are going to do is we are going to talk about most of the asset classes and how what kind of fundamentals they see. First, understand. Let's say for forex. Now, for forex, we look into the very key factors like GDP, inflation rate, interest rate. What a foreign currency does, a foreign currency is basically, it's your currency. Like if you're in India, your foreign, like your currency is INR. If you're in here, your currency is dirham. If you're in US, your currency is dollars. So when we talk about forex market, uh, you review what? You review the economic trends, you review the political trends, and you look at the social trends also that can influence the demand and supply of a currency. And you kind of draw a relationship. Now, again, it's not very easy to do it. So you start looking at some common factors. And the very purpose of doing a fundamental analysis in a forex currency pair, it is also to determine whether the economy is growing or it is shrinking. Because if the economy is shrinking, that we cannot expect the currency to be very stronger, right? So when we talk about foreign currencies, they exist in pairs. And if you are, so now you have seen how currencies work, right? You look at euro USD, you look at GBP USD, you look at AUD USD or GBP euro. If you are analyzing one currency pair, let's analyze fundamentals for Australian dollar and USD. So you will have to look into the economy of Australia, and you will have to look into the economy of US. You have to see, okay, Australian dollar, why it is going down. Australian dollar is going down because there is a trade war going on between China and US. China and Australia are major trading partners, and if US and China do not go well, then there will be a trade war. China will also get affected, Australian dollar will also get affected, US dollar will also get affected. Okay, Australian dollar might come down. So there are these kind of factors which you look into a currency pair. There are a lot of news which comes out every day. Okay, some of them are like this: gross domestic product, inflation rate, interest rates. What I'm also going to do is right now, I will just share my platform screen with you so you can also see what are other kind of news, and you can see it in your platform. So if you have your demo accounts, please log in. Those who cannot log into your demo accounts, by now I'm sure everybody has a relationship manager. Please call them, they will give you a demo account right away, and you can log into it, or just have a look into it. Anyways, this session will be uploaded on YouTube. You can again view this, right? I'm sharing my platform screen with you. Okay. Now I will just, so in your platforms, so far we have covered till search, products, watch list, account. We never covered news and analysis, which is today's agenda. So when you click on news and analysis, you will see Reuters News market calendar. In your live account, Reuters News will always be live, so it will keep giving you news about different instruments. Market calendar, on the other hand, let me just add this to my layout. It is one of the most important. It's like a Bible to a trader who is trading on daily basis, because there are a lot of news which are coming out, and you have to read these news. You have to be there when these news happens, which also gives us a peek into event-based trading. Okay, some of you were asking about the swing trades or long-term trades. There are something called event-based trades also. Event-based trades are whenever a specific data is coming out or news is coming out, you trade during that time. And the prices can be really volatile, so you have to keep your stop losses and take profits also. For now, we'll just look at how a market calendar works. A market calendar, which is also known as an economic calendar, uh, it provides you a list of all the data which is going to come out on day. So if you look at your market calendar right now, let me zoom this screen so everybody can see this. Okay. Now, if you see this today, 19th May, this is UAE time. Now, there are a lot of data. I have filtered it to the ones which can have the highest impact on currencies and commodities, but I will, for your information, select all of this. So the one with the yellow dots have the lowest impact on the market. I've just zoomed in the screen. If anybody has still an issue, please again send it on the chat. I have just zoomed in the screen. I hope everybody can view this screen. Now, if you see the yellow dots, the dots which is one dot, the yellow one, it has the lowest impact. This data has the lowest impact on the markets. When you look at orange dots, which are two, this data may have a medium impact. The ones with the three red dots, the highest, this has the highest impact of the data on the markets, right? So mostly I would always expect you to keep the highest impact in front of you, because those are the ones which are more important. Otherwise, also, these kind of important news and data, it affects currencies market a lot. These are your fundamentals. Okay, these are not your technicals, these are your fundamentals. These are the numbers about currencies and commodities which you should know. Indices also, like Dow Jones and S&P 500, also get affected depending upon how important the data is and what impact it will have as per the current market scenario. I'll give you one example. Look at this. Let me select, okay, Wednesday. I've changed the day for tomorrow. So because most of the data have already come today, so I will see here. Now there is a lot of information, and I will shortlist, I will filter it to the ones which have the highest impact. Now when I filter it, I see this. Now you see the flags of all these important news. There's a flag of Japan, there's a flag of UK, Australia, Europe, Canada, US, right? Now, what we need to understand is the timings which are mentioned on the left side. This is UAE time. This economic data will come out. So 3:50 a.m. Japan market opens around 3 a.m. So all the Japanese data, Japanese economy related data, it comes into the Japanese economic data. It comes around 3:50 a.m. 4 a.m. This is when the Japan opens. Now, once you have seen that data, it will affect dollar yen, it will affect Nikkei, which is the Japanese index. And what is the data? Manufacturing orders, month on month, and manufacturing orders year on year. When you see this economic data on the right side, you see that there is a forecast and there is a previous, and then there is a trend. Forecast means what is the expectation of the data. The previous means how it was in the previous point, and actual means the data when it comes at 3:50 a.m. what it will be, so you can see the difference. Similarly, you see another news at 10. CPI, Consumer Price Index. Now, Consumer Price Index is also, so if you want to read more about the news here, let's say click on this, select event information. So in the event information, when you click, it will tell you. Now this is a UK based news. You see the UK flag over here. Now, what does it measure? It measures the change in the prices consumers in UK pay for retail goods and services. Why do traders care about this? Because this is a measure of inflation in UK, and Bank of England would use these numbers to decide where to set the interest rates. What is the frequency? This is released monthly, about 15 days after the month ends. And what is the source of this? UK Office of National Statistics. So everything is given on the platform itself if you want to read about it. Consumer Price Index, this is the inflation data. This is one of the most important news. So not only UK inflation is important, if you see below that, the Europe inflation will also come out around 1 o'clock. So the euro inflation data will have impact on euro dollar and all euro related pairs, and on German index and on French index. Similarly, UK inflation data will have impact on pound dollar and pound related currency pairs, and UK 100, which is also called FTSE 100, which is your UK market index, right? And if you see below, there is Bank of Canada inflation for Canada, which means they see that what is the rate of inflation, whether it has gone up or come down. Why inflation is so important? CPI, they call it Consumer Price Index. Why Consumer Price Index or CPI data as an inflation? It is really important because the central bank, they take their decisions. So there is something called a central bank for every country. I'm sure you must have heard a lot of times how a central bank works, but I'm just giving you how it is connected to the market. Central bank is like a lender of the last resort. It regulates a lot of commercial banks, and it also performs a lot of monetary policy related functions. For example, US central bank is called Federal Reserve. Indian Central Bank is called Reserve Bank of India. Europe Central Bank is called ECB, Europe Central Bank, and Japanese Central Bank is called Bank of Japan. China's central bank is called People's Republic Bank of China, also called PBOC. Now, these kind of central banks, they are responsible for taking decisions regarding interest rates. What interest rates? Your borrowing or your lending rates, which means the rate at which you borrow money from a bank. Those rates are also decided by the central bank, and they keep increasing it and decreasing it as they do on the basis of the inflation data. And if a central bank increases the rate and decreases the rate, that is one of the most, please remember this, one of the most important news is when the central bank gives a press conference. Federal Reserve, which is a US central bank, has prepared a committee called Federal Open Market Committee, which is also called FOMC. This committee meets 8 times in a year. The chairman of FOMC right now is Jerome Powell. You must have heard in the past, Donald Trump has tweeted a lot of things about Federal Reserve, that they are not reducing the rates, they should reduce the rates should go negative, Fed has gone crazy. So the point is monetary policy makers or the central bank decides what is going to happen to the interest rates. Take a very simple example. You have a business and you want to expand your business. Okay, if you want to expand your business, you thought, okay, I will borrow some money from the bank. The borrowing rate was cheaper. You borrowed some money from the bank, you expanded your business, you hired more people, your production increased. Obviously your production increased, so a lot of people got hired, their wages also came in. So the supply of money increases in the economy. But one day what happened? Supply of increased, kept continue to increase, but also people, they started getting more money in their pockets because the economic activity has increased now. Okay, so a lot of people started getting more money in their pockets, and when you have more money in your pockets, you start buying a higher quantity of anything. So obviously if you need, say, 5 packs of something, you are just buying 3 right now because of the money constraints, but once your money increases, you are going to buy 5. If you are buying an inferior quality good, you're going to buy a superior quality good because now your income is increased, right? So demand increases when the money in people's pocket they increase because they demand more. And when they demand more and supply doesn't match, the price increases. And when the price increases, and if it continues to increase, that is called inflation happening. Inflation is good and bad for economy. It is good if it is subjected to a certain amount of rate. That rate is decided as 2%, 3% by the 2% basically by the central banks, which is the target year on year. And it is bad if it goes really high and if it goes really low. If the prices are too low, then that is called deflation. If prices are too high, it's called hyperinflation, stagflation. You should not have a situation what is happening in Venezuela right now. In Venezuela, if you see, there is hyperinflation and 90% of the local people they are living below poverty line. Today, if somebody receives a cash in Venezuela, they will immediately go and buy a bread or flour or wheat or something of meaningful because they know that tomorrow the value of this currency note is not going to be the same. That is called hyperinflation, and that's one of the worst. So to control this inflation, that people should not have too much money in their pockets, plus people should not have too less money in their pockets, the central bank keeps tweaking the interest rates. Okay, now consider this scenario that everything was well. Go back to the same situation, you want to borrow more money to expand your business, but that time central bank increased the interest rate. And when it increased the interest rate, you thought, okay, you know what, let's keep it here because the borrowing is too expensive. If I borrow for 10 years, I will have to pay a higher rate and let the rates come down, then I will think about it. Which means you are not expanding anymore, which means you're not increasing your production anymore, which means people who you could have hired and paid more money, it's not happening. So the economic activity is not happening. In fact, it is coming down. When that happens, obviously people have less money in their pockets. The supply of cash in the economy is less, which means the demand less, which means if there was a higher demand, it comes down. So the prices they start settling in. That's why central bank interest rate decisions are very important. Federal Reserve meet 8 times in a year and they talk about interest rates. Right now, what you need to know, the world central banks around the world. Now, this is where we come to a point why gold prices are going so up. Why gold prices are going so up? Because central banks around the world, Europe, Japan, US, Australia, Canada, UK, most of the central banks due to coronavirus pandemic, they have reduced down the interest rates, which means the cost of borrowing is very less. Plus, some of the economies like Europe and Japan, their deposit rates are negative, which means today if you deposit money in the bank you will be charged in certain areas of the world. So that's why the central bank encourages the commercial banks to give more credit by making credit cheaper so that the people who need the money they can borrow it. And during the times when the pandemic, so this is a pandemic time, so there are a lot of stimulus packages also coming, uh, something called open market operations. So that's why the central bank of US is called that particular committee, which is formed under Federal Reserve. It is called Federal Open Market Committee. Why? Because the central bank also does some open market operations. How open market operations work? Imagine you don't have money and you go home and you start printing your money. Exactly what is central bank doing? They're coming up with a lot of stimulus, they're printing more currency, and there are different ways to do that. Some people call it bond buying, some people call it a stimulus. It's all same, printing more currency. Layman to understand that government doesn't have money, they print more currency. When they print more currency, the supply of dollar increase, and the supply of dollar increase, the price of dollar comes down because there is excess supply and demand is less. And when the price of dollar comes down, the price of gold goes up. And that's why we have seen in last few weeks uncertainty, gold is a safe haven. People are buying it. Stimulus, interest rates low, dollar supply is too much, dollar is going down, gold is going up. So there are more than one reason when it comes to fundamentals about commodities and currencies. You can look at all these data in the market calendar, read about it, and obviously we'll be there to discuss this further. If you see in the last, there is something called EIA/DOE Weekly Petroleum Status Report, crude oil stocks. Oil, one of the most traded, most talked instruments in last few weeks. We have talked about oil prices going negative. We have seen oil prices rebounding. We have seen oil prices volatile in all forms. This data comes every Wednesday at 6:30 p.m. As you can see, this is 20th May. This is tomorrow. This data comes every Wednesday 6:30 p.m. and it shows you how much the oil producers are holding the oil inventories over a period of week in US. So if you click on the event information here, you will be able to see the change in the number of barrels of oil held in inventory by commercial firms during the past week in US. Why do traders care about it? Because this price, the figure which comes, that how much barrels they are holding, influences the price of petroleum products, which in turn affects inflation. It also affects growth, as there are many industries that rely on oil to produce goods. It's very simple. If now they're expecting that there will be a decline of 745,000. So previous there was a decline of 745,000 barrels. Now they're expecting a excess 900,000 barrels. If the actual figure comes more than 900,000, which means there is excess supply, oil prices might drop. If the supply comes reduced than 900,000 and then their previous figure, then we might see oil prices moving higher. So this is an intraday thing. This is a day on day thing. If you want to take a trade on oil day on day, you should look at the oil inventory data also. You should wait for it and then take a trade, right? There are a lot of these. If you want to take a day on day trade in euro, you should wait for the inflation data. If you want to take a trade in GBP USD or FTSE 100, you should look at the inflation data, because if inflation is high or low, depending on that, central bank will take its decision, and central bank decisions can be making currencies and commodities really volatile, and indices also, right? Similarly, if you check tomorrow, so today is what, Thursday? Today is Tuesday, tomorrow is Wednesday, and then Thursday. Thursday, you see what news you have: unemployment claims, existing home sales. Existing home sales. What does existing home sales means? Event information. When you go, you will see the number of existing previously owned homes sold in US, which means the existing homes, the houses which already exist, which are not being constructed newly, how much of those existing houses have been sold. Why do traders care about it? Because existing home sales gives a good indication to the health of the housing market in America. Why do you want to know how the housing market of America are doing? Anyone among the people, why am I interested in housing markets of America? Why do I need to know why it is in the economic calendar that how many houses are sold? Give me just one reason why the housing market of America should be tracked. Why it is so important. Anyone? Okay, I've received one question. I've received one answer. Anybody else? Why the housing market of US is so important? Why do we track housing market of US? What happened? Okay, somebody said, okay, if you want to buy land in US as an investment way, you should. It's a real estate market. You will understand the employability and purchasing power of the people, mortgages, all good reasons, all good reasons. Also, one of the most important reason, shows buying power as well, absolutely. So these all are very good reasons. And on the top of it, there is one more reason, that 2008 collapse, the recession which happened, it was a ripple effect which happened in the housing market first. So anybody who thinks that housing market is not important, however, everybody over here has given a right answer, whether it is confidence in the economy, buying power, mortgages, real estate, everything. So to have a healthy housing market is not only important for all these factors, but also what happened in 2008. It was a ripple effect. Housing market crashed, and all over the world a recession came. So that's why now it is more than important to keep a check on existing home sales. So this data is also important. It will affect dollar. It will affect indices. Above that is unemployment claims. Unemployment claims is, so in US and in many parts of the world, there is a unemployment claim, which means as a person, if you're not employed, you can claim a certain amount of money. So if unemployment claims started increasing, right now, as you can see, unemployment claim is all time, like it is at a record high. If let me show you. This is the best way. This particular platform also tracks the historic data. So if I show you right now, look at this. It is nowhere near. So the entire stats has been completely different at this point of time. Let me show you the previous. So this is April, March, April, March, April, March, right? Before pandemic. So this was before pandemic. 205,000, 200,000, 205,000, 200,000. December, November 2019, 200,000, 200,000, 200,000, 200,000. After the pandemic hit, 3 million, 6 million, 5 million, 4 million, and now again 3 million, 2 million. So unemployment claims are also increasing. So this is again not good for the economy. So dollar prices, that's why gold is trading at all-time high prices. Because of all these news which are related to dollar, they are coming bad and dollar is getting weaker as compared to gold, and every time gold inches higher, right? So I hope everybody is able to understand what is the importance. This is the fundamentals, how they work in Forex and commodities. All these data, they will impact dollar, they will impact gold. They also at times impact index. Also, you can see there is Japan trade balance, exports and imports. So if exports have increased or imports have increased, or the trade balance, which is the deficit, the difference between the exports and the imports, how the trade balance is. So that is also one of the most important thing which affects your currency. Similarly, if you go on Friday, there are a lot of news on Friday also, something called Purchasing Manager Index, PMI data, which is a manufacturing data. Then there is something called retail sales data, inflation of Japan. Most important data, guys, most important data, make a note of this. Somebody said that, but right now gold is going down. See, gold has rallied for a straight 3 to 4 days. Yesterday, we saw a kind of optimism in the equities, in the stock markets. Stock markets were up yesterday 3.5%. And that's why gold comes down, because sometimes there is a relationship between shares and gold. Gold is a safe haven. Most of the time, people panic, they start investing into gold. But yesterday, a news came out from Moderna Inc., which is a pharma company, that they started their human trials and for the obviously for the vaccine of coronavirus, and the results were promising. So this has given a positive boost up to the shares, and as you can see, since yesterday, most of the shares are up by 3.5%, 4% also. So that's why we have seen people start taking money out of gold and start putting money into equities. Again, a fundamental impact which happened. Moderna Inc. came up with the news, and the stocks went up and gold started coming down. But if you see month on month performance of gold, it is way higher than it was a few months ago. So overall trend for gold is still continue to be higher. Yes, for that particular time, if you see, it is still on the lower side on day basis. But over a period of time, we will see it might be bouncing if the coronavirus situation goes worse. Now, most important news, guys, which comes every first Friday of the month. Please remember this. That news is called non-farm payroll. Non-farm payroll is how many jobs were generated in US in the private sector in the previous month. So non-farm payroll means how many new jobs were generated in US in the previous month in the private sector. Right? Okay. Somebody just shared a very good information that oil prices are going up. Okay. Is it because of the marginal opening of shops, business, people traveling? So yesterday, let me tell you what happened yesterday. Yesterday, when these things came out, that Moderna Inc. is doing human trials on the vaccine, and they're testing it, and the results were promising. So there are a lot of shops opening also. There are a lot of the flights will also start, not all of them. So we have seen recovery in oil prices also. But that being said, in the month of May, there is an output cut also. If you remember, if you have attended my very first webinar, I was talking about a OPEC deal which happened, where they decided to start cutting output in May and June. So there is a small output cut, which is may or may not show the impact, but fundamentally it has shown a positive sign in the oil prices, and we have seen oil prices recovering. Does that mean it is going back to 50 or 60 anytime soon? No, because there is a lot of manufacturing which has been shut down, so there is a long way to go. But yes, Oil prices are moved up due to different optimism, output cuts, and people still, lot of shops have been opened, lot of business are still working, but not at the same pace. So this rally might be not very high and not very promising, but it has increased since yesterday. We saw 8% bounce in oil prices yesterday, and a lot of push in the equities also. Right now, I was talking about non-farm payrolls, which is one of the most important news in the market. Every Friday, first Friday of every month, this news comes out at 4:30 p.m. along with unemployment rate and wage earnings, average hourly earnings. So you should know that non-farm payroll can be really volatile, and I'm going to show it to you. Uh, the last, I think the first Friday was, let me check the calendar, 1st May, but 1st May was a holiday, I think, because of the Labor Day. So the news would have come up next Friday. Okay. Now see, non-farm payrolls, Friday, 8th of May, 22 million, 20.5 million, right? Now, let's see what was the impact on gold. I have not seen it, but let's see it, because sometimes the news is already digested, it is already discounted in the market. So maybe it may or may not have the impact, but let's see. This was 8th May, 4:30. So I will see gold, for example. Okay, let's take a 4 hours chart. April, March, April, and okay, 10th, 9th, 8th. I'm maximizing this, zooming this area from, so I will take 8th May to 11th, 3 days, 6, 7, and okay, let's say 7 May and 11th May. This is 7th May. Now, 8th May is the news, and they already show that what happens when the news comes in. So they already show, now this is a classic example of discounting of prices and what happens. 8th May is the news, 7th May evening itself, because 8th May is the non-farm payroll and it is expected that unemployment has increased and it is going to be a bad data. You see what happens on 7th May. From 1695 in the evening 7 o'clock, gold goes up to 1718, already ahead of the news. And when the actual news comes in, 8th of May, this is 3 o'clock and this is 7. Let's reduce the time period to 1 hour. Okay, let's go zoom out. Okay, now this is the time, 10 o'clock, 12. Okay, look at this, 4 o'clock and then 5 o'clock. 4 to 4:30, 4 to 5 for 1 hour. Gold was moving between, the lowest gold hit in 1 hour was 1706, and highest it went back was 1722. And in the very next 1 hour, it was trading around the highest 1720 against lowest 1709, around the same levels. So only through the non-farm payroll data, only on the non-farm payroll data, we saw gold coming down to 1706 and then bouncing back to 1722 in the very next hour. So, and the day before that, from 1695, it went to 1718. So in 2 days before the non-farm payroll data, from 1695, gold hit 1722. This is the power of event-based trading. So if you want to do, you need to find the right news. In case of oil, it's the inventory data. In case of gold and dollar, it is non-farm payroll, unemployment rate, or inflation data, GDP numbers, in retail sales, manufacturing data. These kind of data are really important, one with the highest impact. Good thing, your advisor will be there with you. and he can always suggest, but this is something which you should also know since we are doing this session. So I'm explaining it to you. So this is and there is more and more data. So today's assignment will be, you will go back and look at the market calendar, and you will read the ones which are most important, filter it to the most important high impact data, and read about it and what impact it has, right? Okay, now coming back, let me switch off this. Okay, now we understood the interest rates, we understood inflation, GDP, for example, also. Now, what about for stocks? Now, for stocks, not necessary. See, inflation, GDP, these all are macro numbers. So obviously, in case of if the GDP starts diminishing, and if the growth rate of GDP is not as it used to be in the previous quarter or in the previous month or the previous year, stocks will also get affected because it's a negative sentiment, but it's more a macro news. But let's say if you want to analyze stock to stock. Now, to identify why should I invest into a company, a lot of you have asked this in the past, that how should we know that whether a stock should be a good buy or a sell or a short sell? Now, for stocks, the most important thing which matters is the numbers, the financial statements, the quarterly results. Okay, so that's why I told you in the beginning that fundamental analysis mostly is done in case of stocks. Rest others, they work on technicals because there are resistance and support levels. So technicals work well with commodities and currencies, but for stocks, fundamentals are really important. So now we are looking at, if you're looking at the company's balance sheet, economic statement, income statement, and cash flow statement, investors can begin to draw a picture of stock's value. Fundamental analysts use stock analysis data to understand where that business is positioned in the industry and the economy and the relative to competitors, right? So we look at different kinds of ratios, and we also check. So there are ratios which are related to the price of the stock. So there is something called price ratios. If let me show you. Okay, now there are lot of price ratios, but there are few key ratios which I think you should know. So when you are looking at the price ratios, what is the importance of the price ratios? Normally, these kind of ratios are helpful also. You can understand if a price of a stock with relation to its fundamentals, like you look at the valuation and you will see whether this price of this stock, whether it is justified as in relation to its fundamentals or not. Which means if I would see Amazon and I see, okay, Alibaba is a better buy, what is the basis of that? Or if Amazon is priced at $2,500, is it a price which is undervalued, or is it a price which is overvalued in relation to its company's fundamentals, right? If you're looking at a company which is $2,500, sometimes you're like, oh, it's so expensive. But is it really expensive, or it is the right price at which it should be trading, or it is actually overvalued? You should wait before it comes down. So to understand that, you always look at the price ratios. Now, when we talk about price ratios, first thing is earning per share. Now, earning per share, you please, if you want to take a note of this or note it or click a picture, or anyways, this will be uploaded later on YouTube. See, earning per share is uh, the profit of the company, and you divide by the number of available shares. And what you will see is you get earning per share. So how earning per share will mark whatever profits the company has made. And when they divide it by the total number of shares, the earning per share comes in, which means they borrowed money from a lot of shareholders, right? So what they have generated for shareholders, how much, if I am holding 100 shares of Apple, and what profit has been generated in total with Apple per share, per contribution of my capital, how much profit has been generated, right? Beat it down to that point. Earning per share, if the earning per share of a company continues to grow quarter on quarter, it is to be taken as a very good sign, because it is very simple. The earning per share comes out when the number of shares, you divide the total profit by the number of shares. If total profit is going higher, which is your numerator. So your earning per share will also continue to go high. So higher profit, higher the earning per share. That's why you see companies which have a history. Apple, for example, for so many years, Apple had a history of giving a higher earning per share and beating the Wall Street estimates quarter on quarter, right? So there are a lot of ways where you can. So earning per share is your first understanding. How do you calculate earning per share? You see the total profits of the company divided by the number of shares which are available. And you can find this information anywhere, by the way, but your advisors will be there to assist you in case if you are trading with us. So during that time, excuse me, sorry. So you will be able to calculate it by yourself also, and this will be easily available. Next comes your PE ratio. Now, PE ratio is also called price earnings ratio, and the formula is within the ratio itself. So you compare how normally, what do you talk about the PE ratios? Now, this is a very key ratio, and it normally will value the EPS or the earning per share of the company's share price, which means whatever is the stock price of Apple and the earning per share as compared to the earning per share, is this stock price overvalued, undervalued, or fairly valued? Okay. Normally, a higher PE ratio, it normally suggests that the stock is overvalued if the PE ratio is high. If the PE ratio is low, then the stock is expected to be undervalued, and it sometimes it is taken as a very unattractive investment also. How it will be taken as an unattractive investment? So if the company is not doing well, what is the PE ratio? The stock price of a company divided by the earning per share. So if the stock price of the if the earning per share is reducing, then the PE ratio might go higher, right? But that doesn't mean that the higher it is a good way to do it. Normally, a lower PE ratio, if the company is not doing really well, then we'll see that investment is unattractive or undervalued. If the company is good, then it's an undervalued stock. If the company is not good and it is suffering through different crises, then it's an unattractive investment. Now, somebody asked me compared to what? Yeah, like when you see a PE ratio 5, what do you compare it to? Very good question. PE ratios are compared to the industry standards. So if I'm looking at, I told you in the beginning that if I'm looking at technology industry, so there will be a median which will be calculated, a PE median which will be calculated for tech industry. That okay, the tech industry has a PE median of this. So all the stocks will be measured higher or lower and against each other. So if I'm looking at Amazon and Alibaba, if the PE ratio of Amazon is lower than Alibaba, then maybe Amazon is undervalued. But if Alibaba's PE ratio is lower, then maybe Alibaba is undervalued. So you compare, and you compare Amazon and Alibaba, but you should not compare, or you compare Pepsi and Coca-Cola, but you cannot compare Pepsi and Walt Disney in their PE ratios. PE ratios should be done at the point when you are comparing similar industry. So it is actually done to find out the overvalued or the undervalued prices of similar industry companies. So in beverage industry, you're looking Pepsi and Coke. You cannot see Pepsi and Walt Disney. If Walt Disney has a PE ratio of 13 and Pepsi has a PE ratio of 11, then Pepsi wins. It's not like that. It has to be similar industry. Somebody asked me, when can we get this? Where can we get this information? Anywhere. Just Google it. You will find it. But to be more fair to you, since you all have participated in Investor Education Week, there is a lot of research your relationship managers can assist you with. So if you need that through Bloomberg terminals, we can easily find it for you, or it is available on the net also. We have to compare with, somebody asked me, we have to compare with industry apps. Yes, like same industry standards. So tech industry is different, food beverages industry is different, sports merchandise industry is different, consumer staples is different. Somebody asked me, how do we know when the PE ratio is fairly valued? See, it is more of a comparison. You cannot. So if you have a PE ratio of 13, you don't know whether it is high or low unless you compare it to another PE ratio of a similar industry. So you look at the industry standard and you see whether it is higher than the industry standard or lower than the industry standard. And then you see the other stock, whether it is higher or lower than that. And again, as I said, see, PE ratio is just one factor. So first, earning per share, then PE ratio. You move further, we're talking about something called Peg ratio. So when you find out the price earning ratio, there is something called price earning growth ratio also. So you look at the Peg ratio also. So now how do you find the Peg ratio? You find the PE ratio first, and then you divide the PE ratio by the annual earnings growth rate per share. Annual earnings growth rate, which means year on year, how much is the growth of the earning per share of a company, and you find the PEG ratio, right? So when we are talking about the PEG ratio also, now PEG ratio can be identified in numbers. So see, the PEG ratio, it builds upon the PE ratio, but it also includes and it considers the company's growth also, right? So if the PE ratio normally, and I'm telling you, normally the observation is that whenever the PEG ratio is above 1, it suggests that the stock is overvalued. Okay. But then you should also, as I said, you should compare the ratio to the industry average also. If the industry average is more than 1, then right. But normally it is considered that if the PEG ratio is above 1, the stock is considered as overvalued. And if it is below 1, it is considered as undervalued. Then there is also something called PB ratio. Wait, I have a question. When we are comparing, maybe the even other company could be less, then how do we know if we are comparing correctly? See, that's why we need to know the industry average. We need to know industry average. If industry average is say 10 and you are below the industry average, which is undervalued. So industry average is mostly, when I say industry average, that means an average of all the PE ratios. Like most of the stocks will have this PE ratio, right? Once you know the industry ratio, then you compare between two stock. So as I said, you have to understand that if your PE ratio is less than this, right, then your stock, this stock is undervalued. What is the authenticity of this? As I said, these are the ratios, the key price ratios, which help you out. And if you see it, see, price earning ratio is dependent on earning per share and stock prices both, right? Now, if the PE ratio is less, that means maybe the stock price is lower, but earning per share is higher. That's why the PE ratio is less as compared to the other. If the earning per share is high and the stock price is still less, that makes that stock undervalued, right? On the other side, if the PE ratio is higher, which means if the earning per share remains same and the stock price continues to go up as compared to it was, so the PE ratio moves higher, which means earning per share is still the same, but price is going higher, which means it is getting overvalued. So this way you have to compare, you have to keep comparing the EPS, and this is a data which is very easily available and your advisors can help you with it. It comes with practice. Financials of the companies are always available on internet. These are publicly listed companies. You will always find their balance sheets everywhere. Next is your PB ratio, which is your price and book ratio. So you compare the price of the stock to the book value. Now, when we talk about the book value, again, see, any stock which has a PB ratio under 3, it is called, like, it's a reasonable valuation. If it is closer to 1, it may be undervalued. So within 3, at 1, it is undervalued. If it is between, like, around 3 or more than that, overvalued. Okay, a reasonable valuation is still always under 3. Closer to 1 could be undervalued, like 0.9, 0.8, it will be undervalued. Above than that, it could be overvalued. So again, PB ratios can be the stock price divided by the book value. Book value is the price at which, so when we look at the IPO, there is always a price which is given by the company. That's your IPO price, right? But there is something called a book value also. So book value is very close to the intrinsic value, and that's why you try to find the EB ratio and see whichever is higher or lower. So these kind of price ratios can help you to understand the valuation of overvalued or undervalued in terms of stock price. Another thing, when you move on, you see the profitability ratios. Now you understood that, okay, is the stock price is fairly valued or not? Once you understood it's fairly valued or not, maybe it's overvalued or undervalued, whatever you find, now you thought, okay, what about the profitability of the company? If you have compared two stocks and you found, okay, this is overvalued and this is undervalued, okay, the one which is undervalued, let me see what is the profitability of this company also, right? You're just not going to buy on the basis of price ratios. So you look at the profitability ratio also. First thing, the return on assets. How do you find out return on assets? You calculate, divide the total income by the total assets. So when we talk about profitability ratio, this is mostly the ROI. Which company is getting a better ROI? Uh, Obviously, it is the question of generating profits in the most efficient way from their business operations. If the profitability ratio is higher in comparison to another competitor, it is definitely an advantage. So these kind of ratios will provide you very useful information when you compare it against a company's history and its immediate competitors, and obviously the average of the industry. So when you see return on assets, a very quick insight on how efficiently a company has been transforming its assets into income. Okay, so return on assets, again, total income divided by total assets. You move on, you see return on equity. Now, return on assets is one, return on equity, how efficiently a company is giving returns or returning income to its shareholders. Equity is what? The shareholders, the people who have given you money has become equity, right? So you have your shareholders. Whatever is your total income, right, divided by your total shareholder equity, and you will see that how efficiently a company has been generating returns on the shareholders income. So obviously, if the shareholders are happy and if the returns are well, then the demand for those stocks will also go higher, right? So that's why the return on equity is also something which you should look at. And then obviously there is your profit margin. Profit margin, we all know, is most important part. It measures how efficiently a business is actually turning sales into profits. You're doing a lot of sales, how efficiently you're turning into profits. Whatever is the total net income, you divide it by the net sales and you will get the profit margin also. So profit margin is something which you always should keep a check on. Then moving on, these, and again guys, all of these for stocks fundamental analysis. Does an average investor will always have to go through these ratios? That is why you always need, I will not say you always need, but I would just suggest you that there is no harm in taking a second opinion. There is no harm in taking an assistance. So that's why whenever you are using any platform, make sure that you get the right kind of research also. You get good information also, and then you see what needs to be done. So these kind of support and efforts, these are provided by Century to the clients and to everyone. Another set of ratios, we are looking at leverage ratios. Leverage ratios, as you know how leverage works, debt and equity. Every company will have a significant portion of the shareholders and a significant portion of what they have borrowed from the banks also. It's a mixture of debt and equity. I told you the concept that why would you buy a house completely on cash, right? You would always have the house which is you will pay a down payment, and then at the end of the day you can always mortgage it, right? You can get the mortgage also. So for these reasons, we have seen debt equity ratio needs to be maintained. It's not necessary that your entire capital structure should has too much debt or too much equity, so appropriate ratio should be there. How do you find out debt equity ratio? You look at the total liabilities over a company's total equity. How much is the equity which is put and how much are the liabilities? Obviously, it's a no-brainer. If the higher the debt uh, as compared to one company, if other company has higher debts, that company is much more riskier. Again, guys, when we are talking about leverage ratios, It is just to understand at how much debt funds a company operations have. Okay, a lower financial or a lower leverage ratio, less a company relies on borrowing, better it is, right? But you also have to understand that companies with low finance ratios may not take the same growth opportunities. Now understand this. When we are looking at a debt equity ratio, we have to understand why we are looking at debt equity, why any kind of debt is needed. If you want to expand your business operations, you take a business loan, right? I'll just give you an example. So if the business has very less business loan, that doesn't mean that all the time that that they have sufficient money and they're using their own money. It simply means that they're not expanding. On the other side, a company with a higher debt equity ratio might be expanding more and making more profits, right? So you need to be very carefully analyzing. Just because a debt equity ratio is higher in one company and lower in another company doesn't mean that this is the right choice. You also have to see how big the operation is, right? That's where that second opinion comes through. That are they doing something new? Are they exposing themselves to a new technology which is going to give them more profits? So this is high risk and low risk. But again, this can be the company which can be making more money in the future and the stock price might go well. And this is a company which might play safe. But again, you have to understand the risk and the reward bit. So that's why you need to look at debt equity ratio. Another kind of it, interest coverage ratio, which means whether your company which has taken loan, do they have sufficient money to cover the interest over a period of time. So it measures how many times a company can make interest payments on its debt with this earning before interest and taxes, right? So whatever earnings are being generated, what we call EBIT as earning before interest and taxes, that whatever earnings have been generated before you have paid a tax or interest, from that particular amount, how many times you can pay the interest. Obviously, a company with a higher interest coverage ratio, if I see that the interest coverage ratio is sufficient, it at least provides a short-term view of the company's health, right? And then obviously there are, so like this, guys, there are a lot of ratios. It's not just the one. This is because of the shortage of time. I'm looking at the ones which can be more important. Look at the efficiency ratio, for example. I'm looking at asset turnover ratio. And again, as I said, these are just the key factors. There are a lot of other ratios which a financial analyst studies. Asset turnover ratio, you calculate it by taking company's total sales divided by its total assets. So this is asset turnover. When we look at asset turnover, it is very similar to the return on assets. Don't get confused. Return on assets is almost similar. It just shows how efficiently business are generating sales from their assets. You see the total sales, divide by the total assets which you have, and you will get the asset turnover ratio. Similarly, there is an inventory turnover ratio. Now, this normally means how many times a company has sold and replaced its inventory. And this can go different between different industries, but a higher company's inventory turnover is better. So if company A has a higher inventory turnover, it is better. How do you calculate this? Whatever is the cost of goods sold, which means the actual cost, the direct cost, you divide it by the average inventory and you will find the inventory turnover ratio. See, because it measures how many times the company has sold and replaced its inventory, a higher inventory turnover ratio in one company can be better than the other, because most of the times they have sold and then again, so which means the sales are high. So this is efficiency ratio that measures what you understood. Price ratios to understand the undervalued or the overvaluation of prices. Then there is efficiency ratio. There is profitability ratios to understand the profitability. There is uh, leverage ratio to understand the debt levels of every company. Then there is efficiency ratio. Then there will be liquidity ratio. Then there will be current ratios. There will be a lot of ratios which a financial analyst would study and then take a decision. This is a part of fundamentals. Okay, so that kind of effort goes through when anybody analyzes a stock fundamentally. Now, moving forward, once we have analyzed the efficiency ratio for the stocks, so this is one thing which you look into a stock. Apart from the ratios, these were quantitative factors. I told you there are qualitative factors. What are quality factors? Quality factors exactly like if pandemic is happening, people are at home watching Netflix, right? So as a investor sentiment, I would be pushed in to buy shares like Zoom, shares like Cisco, shares like Netflix, Roku, Disney, right? And on the other side, there is no travel or tourism. So as an investor sentiment, my first thing will be, okay, I'm not going to buy any travel tourism companies. Boeing stocks are coming down, right? So this is fundamental news which affects. There are a lot of news fundamentally which affects prices of shares. Let me give you one example. Uh, I'm not sure how many of you know Carl Icahn. Carl Icahn is a stock activist, and there is one more, the Carl Icahn, and he's very famous fund manager. Okay, so there are few stock activists which always comes out in public and they talk about uh, Bill Ackman. Bill Ackman. Wait, let me search. Sorry, I have this habit of, yeah, Bill Ackman. He's an American investor. So Bill Ackman, Carl Icahn, Warren Buffett, for that matter, these are stock activists, big investors. Many a times, you see, when Apple stock prices used to come down, Carl Icahn used to tweet that I am increasing my stakes in Apple. Prices are coming down. It's a great opportunity, and the prices used to go up just because Carl Icahn increased its stake. Same for Warren Buffett. Same for Bill Ackman. These kind of stock activists, they have on several occasions, they have favored these companies, right? And we saw the stock prices going up. Another example, quality factors. Elon Musk Twitter account got hacked, and somebody from the Twitter account tweeted on account of Elon Musk to the public saying that, wow, Tesla is so high, almost overvalued. This was from Elon Musk's Twitter account, and stock price came down by 6% on the very same day. So sometimes it's not even your mistake, it's the investor sentiment. That's the qualitative factors which are very difficult to understand. But for that, you need to be aware about what is happening around the world. That's why I told you, read the newsletters, just be informed. Okay. It takes a certain amount of involvement to be a part of this investment also. Now, coming back, we are talking about fundamental analysis in commodities. As we talked earlier, I covered a lot of news about Forex. A part of that goes to commodities also, industrial production, GDP data, inflation. It does derive a lot of commodity prices, but let's be very clear about, say, agro-based commodities. Agro-based commodities like rice, wheat, sugar, soybean, cocoa, coffee. These kind of commodities, their prices rely a lot on weather conditions, seasons. Uh, Most important fundamental, in China, there was swine flu, 1 million pigs slaughtered almost every day, and we saw pork prices increasing overnight, exponentially high. So this kind of fundamentals, it affects commodity prices also. Weather conditions, seasonal conditions, when is the harvesting season. In case of oil as a energy-based commodity, it's a no-brainer. Geopolitics, uh, output around the world, the global pandemic, coronavirus, reduce the demand for oil, prices come down. Uh, Anything happening in Iran, between US and Iran, in Libya, geopolitical issues, oil prices always react. Drone attacks on Saudi Arabia, oil prices pushed up 10%, 12% high. These are fundamentals for oil, right? Um, Gold, as I said, it's a safe haven. So any kind of tsunamis, earthquakes, war situations, North Korea missile test, global pandemic, Brexit referendums, US elections, trade war, they will, all of this will affect gold prices. Silver prices as a commodity, industrial application of the metal is more in case of silver. So if manufacturing is not high, then silver prices get affected. Similarly, you move on to different commodities. Copper, for example, is an industrial metal. So with copper, what happens? Manufacturing is slow. Copper, lead, zinc, these prices get affected. So in commodities, you have to keep checking. In case of agriculture products, you have to keep checking on weather conditions and their seasonality patterns. I'll give you one example of the seasonality pattern. Let me share the screen. Application of Chrome. Just 1 second. Okay, I will share it with you. Somebody just asked me about Bitcoin. See, when we talk about fundamentals of Bitcoin, I wanted to include into it, but again, cryptocurrencies have not been available for me. Okay. I think there is a problem in the connection. We're not at all. Okay. Okay. Refresh. Please wait 2 minutes. Okay, is it working now? Can everybody hear me now? Otherwise, I will just refresh it. You just have to wait for 2 minutes. I have to refresh this. But if you can hear me, then I will not have to. Okay. Can everybody hear me now? Okay, perfect, perfect. I have no clue. It's maybe it's my system. Maybe uh, never mind. I have a cousin on the in the other room who's very active on PUBG and Fortnite and other games. I think he's live streaming right now, and I think that's going to be a bit of a hassle. But again, I think most of the webinar softwares are also technically very congested. So I'm really sorry for this. The question was that what about the cryptocurrency? So what I was telling was most of the traders, they use technical analysis to trade cryptocurrencies. We should not completely ignore the fundamental values because um, it is possible that fundamentals will affect cryptos. And when we are looking at variables like legitimacy, regulation, security, this will affect supply and demand of the cryptos. And even if it doesn't change, the news surrounding these areas will always affect the sentiment. The adoption of cryptocurrency as a currency, their trading volumes. And Bitcoin it's a very new market. It's not a very conventional market, right? So it is not very much trusted by many institutions. So there is a possibility that we will always have a very limited sensitivity to the fundamentals of this. That's why cryptos is something I do not normally promote as a tool for investment. You want to take that chance, you can take chance into Forex. Still, you can take chance into Forex if you're aware about the risk. Even Forex is dangerous, but at least it's widely accepted. So central bank decisions, interest in industrial productions, interest rate, GDP, inflation, it affects the currency pairs and commodities directly. Cryptocurrencies, again, they have their fundamentals, but their fundamentals are very not very robust. We always see mostly these fundamentals which are regulation of cryptos, which have been in a while for now. It's not regulated yet, it's not accepted yet, so it's the same record which keeps playing again and again. Now, guys, we understood the how the agro commodities and everything works. Now, what I'll do is, do you have anything else? Okay, and this is the last slide for me. Now, what I'll do is I'll quickly share the platform once again. Somebody had a problem with the stop loss while I'm explaining you guys. For next, US market is open, right? So we will look into some stocks also. Let's see. Let's revisit what we checked tomorrow, what we checked yesterday. I think I still have the same demo account, and we'll see what has been the change since yesterday till now. And I will also show you some strategies. Let me see if I can share this. Okay. Application window. Yeah, there it is. Okay. What I was showing you about the fundamentals, I hope everybody can see this. Something called seasonality pattern. And now we are back to the trading strategies bit. Okay. So you look at this, and we will go back to the platform and also see this part. This is the strategy part. Gasoline seasonality analysis. Remember, I was telling you yesterday that there is seasonality is also a kind of strategic analysis. Look at this chart. Okay, this chart is of gasoline prices, gasoline returns from 2005 till 2020. It is dotted also that the month of March from 2005 to 2020, month of March has shown positive returns every time. Can everyone see this? I hope everybody can see my screen, which I have shared right now. If you see this, these are gasoline returns month on month from 2005 to 2020. And if you see in 2005 to 2019, March has always been positive, right? What is the reason? Because November, December, October, mostly it's cold. January, it's cold in US. In different parts of the world, there is snow. Cars are not moving much, so the price of gasoline starts coming down. And in March, summers come back and starts recovering. So these kind of strategies are called uh, seasonality patterns. So I told you about commodities when I was explaining on day one that commodities have this thing which is called seasonality, which is called trend. So many a times there are a lot of investors who take long-term positions in commodities expecting that the trend is on the higher on the lower side. If it is on the lower side, they would short sell. If it is on the higher side, they will buy. But either way, they would look into the seasonality also. This is one thing. Second, there is one more strategy which is called, so I'm talking to you about the strategies because tomorrow it will be all technicals, and then on Thursday we'll do live trades. So these are some strategies which you can try today. Again, this is an old one. March is already gone, so we cannot use it. This is just for your illustration purposes only. Similarly, there are strategies like, okay, since we talked about the ratios, this is a report which is normally available in your live accounts. Okay, let's see, yeah, you can see this. Okay, now ExxonMobil, it's an oil company, right? Now look at the fine. So like this, the financials of every company are available on your platform, and it will be available to the advisors. Now see, this is financial as 10th April. Again, quarter was in April, fiscal year end 31st December. So if you see dividend per share here, ExxonMobil. From 2010 to year till date, the dividend per share has been increasing at a very steady pace. It's a good thing. If a company is giving you steady dividends, it's giving you a good dividend, and it is keeps on increasing, it's a good thing. Similarly, look at the revenue. 2019 revenue 256, but 2018 it was 279. 2017 237, 2016 201, 2015 240, and it used to be 2011. So see what happened. 2011, 12, and 13 and 14 revenue was still high. What happened in 2015? 2015 when oil prices, 2014 and 15 is when oil prices came down to 27, right? 2016 when China manufacturing took a big hit, right? So you see the revenues coming down. Similarly, if you see the valuations here, you're looking at the PE ratio, you're looking at the price and book ratio, you're looking at the fair value, return on assets, return on equity, return on invested capital. So normally you compare these ratios with a similar person in the industry, a similar company in the industry, let's say like Chevron or ExxonMobil, to or ExxonMobil and Schlumberger, different oil companies and with different numbers. So the advisor can always suggest you that, right? So this is one thing which I wanted to show you. Next was something which was related to the earnings bit. Let's go to the platform first, and then we will use how first see how to use the stop loss before many of you leave. Chrome tab and trade room. Okay, now first let's go to our watch list. Investor Education Week Day 2. This was a watch list which we prepared last time, right? Now, I don't know how many of you have been looking at this, how many of you have seen these things, but let's try to remember if we know any of the prices. Anyone who has done any kind of observation in last 2 days, we made the list yesterday, right? We are looking at Facebook, Microsoft, Apple. Any observation, anyone? Microsoft is 186, Apple has also gone up, HSBC. I'm sure many of you were tracking this also, right? It was a part of your watch list. Walt Disney, which is around 114 today. Then Amazon.com, which is around 2450. US 30, it is 24,448. See the low and high prices. S&P 500, again, it is coming down today. Gold prices are moving higher. Now, can you see the relationship? Okay, somebody has observed Netflix has gone up. Where is Netflix? Netflix has actually, recovered. That's right. Netflix has recovered. Also, if you see, look at US 30 today, Dow Jones, just below Netflix is Amazon, below Amazon is US 30. Today, US 30 Dow Jones is down. And now today, see the gold. Gold cash, it is up by 0.4%. US 30 is down by 0.4%, gold is up by 0.4%. So the answer to the question, somebody asked me that why gold came down. So gold came down yesterday. Why? Because shares continue to go up. Today, equities have come down, so gold has started moving higher. So sometimes profit booking happens, sometimes the data comes out. There are a lot of fundamentals which survive it. Now, if you see most of the shares like McDonald's, Volkswagen, all these shares, they have, because yesterday markets were up by 3 to 4%. So today there might be a bit of profit booking. People might be booking profits, and we have seen stocks coming down, right? Somebody asked me how to put a stop loss. So I'm just going to show you it once. This is my total account value right now, say 90,000. So let's say if you buy any stock, I'm going to buy gold if it is going up right now. Let's say I buy 100 ounce, margin blocked is 870. I have $90,000. I buy, and I bought it, 100 ounce. I go to my positions. Now I see I have gold. So 100 ounce I have, there is something called a stop loss here. You will find the stop loss in your order ticket also. You can put it then, or you can put it now. Click here, stop loss, or click on this modified trade. A window will appear. You can see stop loss. Click on stop loss. There will be a number, but you can put your number. So let's say if you don't want to lose more than $500, right? 500 price will be calculated. Similarly, you can put a take profit. Let's say $1,000. A take profit price will come. Modify this. Now you have a stop loss and take profit, right? So you can easily put a stop loss or a take profit in your trading account. Also, let's try to understand. So guys, tomorrow, what we'll do is I will call Vivian and I will see if it will be a right time, because Vivian normally 5:30 market opens, so he has to cater to a lot of clients. So I will see for how long he can stay, but anyways, I will be there and we'll do a technical session. Now you've understood how the fundamentals work, uh, daily news, important news which comes across in the market. That is also really important, right? Tomorrow we'll discuss a newsletter. Tomorrow we'll also discuss something called the trading levels. So tomorrow you will get to know the resistance, support, charts, what is a candle from a very basic. We'll do a very basic technical analysis session and then we'll see if you're up for more advanced one. But we will just show you how to draw a trend line, how to find out the support and resistance, what tenures, what charts you should, what hours you should look into, and a couple of studies like RSI, which are easy to understand, and then go ahead with it. So once you know the technicals tomorrow, then on Thursday, 5:30, we'll do a live trading session with all your demo accounts, and then you put a trade, put a stop loss, and monitor it. Right? So you will know what to do. After that, if you will have any issues, I will always be there to conduct more and more sessions. Right? Anyone else has any problem in terms of the platform understanding? See, those who have not attended the session, compared to the earning in terms of the platform understanding. See, those who have not attended the session, you can please go to YouTube and check. We have uploaded the last 2 days of sessions, and you will be able to find it. So anyone, if he has not, rest of you, anyone has any issue with the platform, anything you like to know, please write me a question. Also, sorry, where is my slide? Very quickly, guys, this is something which is really good. We have started these sessions again. We never used to do a webinar before, and now we have started very frequently. I want to keep it going. So please review us on Google. Put your comments if you like what you like about the webinar. Give us good reviews, and we'll continue to do these more and more sessions for everyone. The idea is again to keep spreading the awareness about this. So please review us on Google, Century Financial. Write your comments. How do you like the session? How about the content? What do you like the most? And we will keep improving on it. So that being said, markets are open. You can switch on your platforms, look at your watch list, and again, do the same exercise which we did yesterday. Do your trades, write the rationale behind it. Those who have not done today, please try to do it today. Write the rationales, and then I will be personally, I want to say that I will check it, but I don't want to sound like a professor. So you can send these things to your RMs and they will send to me. So I will look at the rationals and I will add something onto it and I will send it to you. I don't know how good or bad it can be, but at the end of the day, it is just a exchange of ideas. I get to learn a bit, you get to understand a little more. I think fair enough, right? So that being said, guys, thank you so much. I've seen so many familiar names from the day one till now, and everybody is still attending it and not bored yet. That gives me a very good impression about you, all of you also. So I'll continue. We'll meet once again tomorrow, hopefully with Vivian, and I will also be there and we'll do some technical sessions. Uh, okay, somebody asked me, how do I get the watch list which you created in first 2 days? So, sir, first thing, you can go to YouTube and see the videos, but I will very quickly explain it to you here. Um, so it's a very easy way. This option is here for watch list. So when you click on the watch list, click on create new watch list, and then you can select here, give it a name. Let's say demo A, and this watch list is saved. All you have to do is just now add your product. So let's say you like Facebook. Select Facebook, add it. Again, add, say, Apple and Apple shares. So like this, you can keep adding different. For a better understanding of what we have done, please go and attend the look at the YouTube, and you'll be able to get complete run through of what I have discussed in last 2 days. And come tomorrow, we'll have a technical analysis. Once again, thank you so much for staying there with me. Please take care of your health, take care of your family, be in good health. Do not go out, stay home, stay invested, and please stay safe as well. My name is Yogesh. I will be again putting this session also in on the YouTube, so you can go to YouTube, subscribe Century Financial, review us on Google, and we'll meet again tomorrow also. Thank you so much, guys.